Hey, good morning, everybody. Welcome to Facebook Live with Steve Goody and Dave Windler. Morning, Dave. How you doing?
Morning, Steve. Good, mate. Very, very good. Happy Friday to you.
You too. You were in the office today. You're in the mighty Te Atatu Peninsula, are you?
Definitely am. Yeah, back to almost some sort of normality. Don't have to work from home all the time anymore, but it's good. Really good.
What happened to the Walkie Talkies? You were out with a cell phone on the peninsula in the mornings, giving some good advice and talking straight to camera. Those were great.
Yeah, I enjoyed that. It was kind of, first time for a long time I've gone out for a walk every day, probably like most people. So back into the grind a little bit, and those good habits have disappeared again. I've got to confess, to be fair.
Yeah, it happens, eh? Well, look, I'm going to welcome everybody online. This morning we're going out live to the Steve Goody Property Coach Facebook fan page of a little over 11,000 people. We're going out to Dave Windler's Facebook fan page for Mortgage Supply Company, which is coming up on 6,000 people now. We're also talking direct and live with the fan page for Nexus Property, my good friend Shane Carruthers' page. My YouTube live channel is seeing this as well. So, essentially we're probably going out to about 30,000 people this morning. I'm not nervous. I'm wearing pants and everything.
No pressure, Steve.
It'll make you feel nervous here, Dave.
Yeah.
He takes a deep swig of his vodka. So I just really wanted to welcome everybody on board and just say thanks for firstly for watching and tuning in today, and secondly for supporting both of us. Our Facebook pages, both of Dave and I have gone mad in the last few weeks. We've been stuck on the couch like everybody else, and I think like everybody else, we've been thinking property. We've been thinking, what are we going to do after this? It's a bit like having a holiday. First week's great. After that, what's next, right? So I've really enjoyed doing these Facebook Live streams and bringing you guys some content, some information. I hope you guys have been loving it as well. What I'll say, though, is we're streaming this through a piece of software that allows all of those pages to come together with one lot of comments. And so you can type in, wherever you're watching it, type a comment on that, and it actually comes to Dave and I directly. So what I'd say now is there's, 30-odd people online. Hit the like button, give us a quick thumbs up, let us know you're there. And also type in the comments and tell us where you're actually watching from, because last time we did one of these, we had a huge population in Auckland, quite a few Wellingtonians, and some people from down south obviously as well, but then we had loads of offshore people. It was really interesting to hear the perspective of people, Kiwis and non-Kiwis living offshore and what they were up to. So chuck a quick comment in there right now. Hey, you got nothing better to do? You just sit there and listen to me talk. Chuck in a comment, tell us where you're actually coming from. Let us know. And obviously, as we go through talking about this, we can actually answer your questions live as well. So if you put a comment in there, we're going to see it live time, and we will answer that question. If where you are, it is not 10:03 a.m. on Friday morning, i.e. you're not watching this completely, absolutely live, chuck your question in anyway, because, hey, we'll go back and we'll answer the questions via text later on. So streaming live on Greg's TV. Hey, mate, how you doing? Good to see you. Waikato, Wellington, live on Facebook. No kidding. Ben from Napier, how you doing? Christchurch, Raglan. Yeah, so, lots of people watching. That's awesome. Thanks for that. So as I say, as we go through, bang a comment in. We can answer your questions. When I suggested this to Dave a few days ago, I put a few comments up on both his and my Facebook page and said that you guys should pitch questions to us and we can answer them live this morning, which is exactly what we're going to do. I've also come up with some nice curly ones for Dave as well. He is woefully underprepared, but incredibly professional at having my questions thrown at him. So first one I'm going to start with is, obviously you've been flat out at the moment, haven't been able to walk the dog. How long is it taking start to finish to process an application at the moment? Because I know it takes a lot of time in the pre-work. So, let me know. Where's it going with you?
Yeah, look, service level from, banks, and just to let everyone know, in general, we deal through centralized broker units that have got, SLA timeframes that can, move in and out all the time, and all the banks are different. When we hit COVID, it was very, very slow because a lot of those resources were put into hardship teams to support what needed to happen at that time. They're now coming out of that, and the broker units are coming back to some sort of capacity. If we take a timeline from when we've got all the paperwork in accurately from a client, we're normally on a 48-hour turnaround of that paperwork while we fit it into queue. And then SLAs with banks, 5 to 7 working days would be average. Some are quicker than that, some are longer than that. So definitely one of the filters that we run for a client when we're thinking about where we might place the business is how quickly do we need to get this done. So yeah, turnaround times for brokers is an ongoing industry issue, in my opinion, and just something we just need to manage.
So
I think certainly for people who are thinking of getting back into market, investing again, buying a home, whatever it is you're doing, think about a reasonable timeline to operate that in and get prepared early. It puts you under less pressure when you're in the moment of a sale and purchase agreement and a live deal. Do all your homework up in advance. Start working with your advisor early, and everything will be a little bit more relaxed.
Yeah, fully agree. There's a lot of paperwork that the actual client needs to go away with. I've seen the lists come out of your office for my funding where it's like 3 months of this and it takes a lot of time. So what's the nice client look like, and what's the perfect client look like? Because the best way to streamflow this is to be a perfect client to yours, so that you can look into the bank.
Absolutely, mate. We're human, and when a client presents all the information you need in one go accurately, it kind of tends to slip its way towards the top of the queue. And I think
with a little bit here, a little bit there.
There's nothing worse than chasing paperwork, but we do appreciate and understand that the paperwork side of things clunky. But what a good advisor is trying to do is present you professionally to the bank.
Yep.
And we've got reputation to uphold as well. We want a situation where our application gets in queue at a broker unit, and another human being, because we're all human, goes, I think I'll take Dave Windler's deal next, because I know it'll be well put together. I know the diary note will be all in good order. I'm going to be able to read this and understand what it is that the client's wanting to do, and all the paperwork and all the calculations will all be in good order. And for me, working at a high volume level, I've got 4 full-time relationship managers, 4 loan writers, if you like, whose job it is to make sure that's happened. I've just got oodles of lending experience to make it so.
Yeah. So I mean, that's actually a really good point, that a lot of people may not know this, because a lot of these webinars and stuff, it's you and me talking about lending and funding and finance, and I think people get a lot of value out of it, but they don't maybe know the size of the back end that you have. So you have a crowd of people in your office, and the crowd of brokers working, and there's different branches of you, and you aggregate work for other people on top of that. So this is why to the people.
Yeah, and I think that's when if you start thinking about, people making decisions as to who they want to work with. There are plenty of good operators in market, but you've got to go after that expertise. I'm a big fan of brokers working, in clusters, or if I can use that word, in groups and under a banner, because we workshop deals at the office all the time. I've got 20 brokers in the team. We're all doing different deals at different times, and sharing those experiences, because most of the time a good broker will place a deal, get the job done. But sometimes you can miss a trick, and you can get a better outcome for the client, whether it's a slightly higher loan amount, whether it's a better ability to recycle deposit. The little things really matter when you're investing and you're lending to investors. And really just encourage people to go after experienced advisors who love and predominantly deal with investors. And there's a good bunch of them out there for sure.
There absolutely is, and this is also why I work with you and recommend you as a business, and I would recommend people worked with you even if we weren't working together, because I think a lot of people, when they do funding, they look and they go for the shiny thing, and the shiny thing with investing is lowest possible interest rate and highest possible loan to value ratio, and that's not necessarily always the best thing for the client, and it takes a decent strategic advisor to be able to sit down and go, hey, look, what you're doing is probably not right. We'll totally let you do it, but this is how we see it, and come to it from a place of being an investor yourself and knowing the market and having that experience behind you. I think that's one of the most important things.
Yeah, and I think strategizing the lending piece is really, really relevant and important, and we can do that best when the client is really clear on what they want.
Yep.
They're really clear about their goals and objectives and where they want to go to, that those goals and objectives are reasonable and they're not pie in the sky. It just gives us a real clear target to hit, and we can, dovetail our lending strategy to support your investing strategy. Really important combination there. Yeah.
All right. Well, let's do we've got like 60 people online now. Let's do the most least accurate poll of anybody's ever seen. Chuck in the comments now and tell me whether the lending that you have at the moment is fixed or floating. I'd just be interested to know. If you guys online don't mind, chuck it in there and I'll read it out. I'll have a quick look at it. So are you fixed for a period at the moment with a certain interest rate, or are you on a floating rate at the moment? Because this kind of leads into the next question that I've got. Historically low interest rates. So we can, it's like a roller coaster at the moment watching this thing, except it's only going in one direction at the moment. I'm watching it and going, it's hit after hit. Stuff.co, the Herald website, every day there's a new thing. And we get great rumors like we talked about this morning with BNZ looking at doing investments at 80% suddenly as well. So we've started to get some stuff come in, fixed, mixed mortgages, yeah, fair call, fixed, both, some mixed. Yeah, most people are a mixture of each, Floating for 4 more months, that's a great one. That'll help you out a lot. You make some great choices out of that one. 85 fixed mortgages over various and 15 floating.
Hopefully there's a percentage sign missing there, maybe.
Yeah, maybe. So everybody's sort of got a mixture of what I'm reading there. So a lot of people are actually asking me at the moment, I'm sure we're getting the question as well, what do I do? Should I fix today? Should I leave it floating? Go, Dave. What do you think on that one?
Yeah, I mean, and all of this sort of commentary will always be scenario specific. We're going to talk in general terms, but it doesn't necessarily mean that what I'm about to say applies to your circumstances. Okay, but I'm always a big fan of an interest rate in the hand is worth 2 in the bush. Mm-hmm. All right. So as you start to look at your rate decisions, and you might have something coming off a fixed rate now, and obviously celebrating that because it's a good time for that to happen. Don't necessarily think that rolling on to floating is the best idea. Your best floating rate's probably going to sit at around about 3.99, whereas you could hop onto a 265, 269, 279, 299, anywhere between 1 and 5 years, which is all well and truly above 1% lower than what your floating rate would be while you're sitting there waiting for the next rate drop. Okay. Most of the time at the moment with refixes that we're working on, or loan structures that we're working on every day, we are staying short. And generally speaking, 9 out of every 10, we're just fixing for 1 year. Occasionally we're doing a 6 month. Those rates sort of sit mid 3s and have come down again. But all the indications are that we are getting is these rates will continue to drop. I think about a week ago I was suggesting we might get a 249 for Christmas. Thanks for coming. I can see it being potentially lower than that. Swap rates are really low. Clear, one of the key things that came out this week was the Reserve Bank's May financial stability report. Always worth a read, and then you've got to read between the lines and understand what the message is. And then there's a very clear message from the Reserve Bank. Pass on margin. Reserve Bank again. Look, we've done our bit. We've smashed out some quantitative easing. We've made every post a winner. Banks, now it's your turn. You got to do your bit. Pass on some margin and start lending. Now, rates have dropped nicely, but my area of concern is availability of credit. There's no point in doing a song and dance about extremely low rates if you can't access that approval. You don't get the rate until you've got the approval. And I think reasonably so through the last couple of months, banks have tightened up credit policy and are being relatively conservative until they know where the lie of the land is. Outside of rates chopping and changing every day, I don't think I've gone through a period of time where credit policies have had the speed wobbles. Lots of little micro changes, nuanced changes. We won't accept border income anymore. We're not accepting Airbnb income anymore. Kiwi Bank rumor this week, for self-employed borrowers, they automatically discounting your income to 70% of its value. An automatic assumption that you are self-employed, therefore we can't rely on your historical income like we used to be able to, because we're concerned about what your future looks like. which is in stark contrast to, you know, how some of the banks are looking at it, and they're being a little bit more rational. You know, what sort of line of work are you in? Is it tourist related, for example?
Yeah.
Have you done your 2020s? Now, right here, right now, you know, we're in May, and banks are looking to see your 2020 financials instead of relying on 2019. And it's very, very early for that to happen. Normally, it's, you know, a good few months away before we have to start producing 2020s. What's your cash flow forecast like? Have you got any forward contracts lined up? A lot more layers of questioning around income, particularly with self-employed people.
Yeah. So what I'm hearing is a lot of the time is every single solitary borrower that is coming through your doors and is trying to buy a house is totally different based on what they already own, what their income is, where they're getting it from. You know, you might have a boarder in your house paying 120 a week, and one bank will take that, one bank won't. One bank will look at Airbnb a certain way, and one bank won't. I've got boarding houses, obviously, and that creates another issue. Banks are looking really closely at what your income is, but also how you receive it and how you can prove it. And, you know, as we all know, proving lending is a legend of a job sometimes, you know, proving that you actually can afford it from income perspective. So each individual bank's treating it differently. Now, is that interest rates have gone down. Banks, reserve banks try to create more money so that people will lend, but banks themselves have actually tightened up on what
they have, mate. And I think, you know, you're picking up on a point there. The main difference between lenders is, you know, how much will they lend you based on your income and expense situation. And, you know, it's a difference between, yes, this loan's approved, and no, it's not. Or just as importantly, it's the difference between you can buy that $300,000 house or you can buy that $500,000 house. You know, you can walk. It starts to influence your buying decisions. And if you think about those, that, you know, 300 or 500, and that, you know, if you'd just walked up the road to the other bank, you'd have got a much better approval to buy a much better property that would give you more value over, you know, the longevity of time. It really can impact on wealth creation, and this is where a good broker knows that already. They know all the maths. They know all. You don't have to run around trying to find who's going to be the best fit for your circumstances. We should know that. And I think the biggest thing right now with the rate drops that we're seeing is that the gap is widening on a day-by-day basis almost between actual interest rates and the servicing calculations that banks are using. Yeah, that hasn't changed. I mean, you know, they're all in and around 7%, give or take. And, you know, that's a big gap. So I think there's starting to be a little bit of growing pressure on banks to review that. And I think as soon as they've got confidence in the near future, they may well look to do that.
So I think that's a super interesting point, and I think that that's a point that a lot of people may have missed, and I'm going to totally dumb that down. So if you borrow $800,000 at 4.49% interest, even if you're just interest only, that's going to cost you $690 a week to repay over a normal interest only loan. If you break that and take it down to 2.69%, it actually costs you $413 a week to repay it. So $413 versus $690. So you're actually saving $276 a week. And a lot of investors are then looking at that and going, oh, my income's just gone up $276. But your cash flow has gone up $276, not your income. And so the bank's going to look at that and go, oh, so you were at 4.5%, you're now at 2.6. We're still going to use 7. We're still way up here. And so many people are coming to me and going, oh, Steve, I got this great job. Wife's got a job. Household brings in $260,000, $270,000 a year. We've got 2 rental properties. They're positive geared, great cash flow. Bank says I can't borrow any money. What's going on? And I'm like, don't ask the bank. Go and rob the bank. It's your only choice, you know, because you know they're really being a pain in the butt, aren't they? So what
and it's a frustration because you look at the sensibilities of affordability and you go, this client can afford to take on this mortgage, but the calculations are so conservative right now that it doesn't necessarily lead through to an approval. I mean, picking up on that, you know, people coming off mid-4s, high 5s, or whatever it might be, and then staring down the barrel of you know, 2.65 for the same.
Yeah. At 2.65, suddenly they're loving it. Oops, Dave's frozen. Give him a minute. While Dave's waiting to come back, let's have a quick poll again. Do we think rates are going to go lower or not? Chuck in an answer there in the questions and comments section and tell me whether you think rates are going to go up or down at the moment. Let's get into that. I'll answer some of these questions. Oh, thanks, Steve. Love your videos too. 6% coming off fixed. Any questions? Bang them in there and let's go. Come on, Dave. No, he's died on me. I'm sure he will log back in again very shortly. One other thing I was talking about with that interest rate too, and I'll cover that as well, is when I asked Dave whether he thinks people should fix it at the moment, one other perspective that I saw too was if you're at 4.5% and you're looking at fixing it, say 2.69 or around that 2.5% rate, I was looking at the option, obviously, of fixing for an absolute longest term possible, because I'm looking at, if you could do sub 3% fix for 5 years, you are basically turning any particular cash flow property that you've got that's already cash flow positive into much higher cash flow positive property for a fixed 5-year period. And so if you can do that, even if you don't hold the property for that entire 5 years and you just choose at some point to sell the property, you can keep that mortgage even if you sell the property. Now, that's going to sound really totally counterintuitive, and I'm going to do a quick video on that later in the week and chuck it on my Facebook fan page. Dave, welcome back.
Not a good time for my internet to kind of decide it would like to stop.
Oh, mate, tech problems. It always happens.
No, apologies. I don't know how much of that last bit you guys got, but maybe we can.
Yeah, most of it, and then you cut. But what I was just covering was I was going back to when we were saying like fix or float. And I know you're a fan of fixing. It's a guaranteed result. And I think if you can fix for 5 years because you know the property is going to stay in your position for 5 years, that's actually a really great move at the moment because you're guaranteeing that return for a fixed 5 years. Now, in the past also, if you chose to sell that property within that 5 years, most people think they have to break the mortgage. But sometimes if you choose to sell the property, you can keep the mortgage.
You can transport it.
So I don't think people should be terrified of fixing long term, particularly when the interest rate you're fixing at is sometimes 4% lower than the 25-year average interest rate.
And 299 is so attractive. It just, again, it's going to be a personal decision. Some investors will look at the cash flow on a property, figure out what their repayments might look like. Let's say even on a principal and interest basis, and go, you know what, if I go 299, go principal and interest, I'm set and forget.
Yep.
All they've got to do is focus their attention on managing the property, looking after the tenant, and certainly, historically, I've been an avoider of a 5-year fixed rate. You could look at it now and take it, but would you regret it if rates go down to 1.5% for 1 year?
Yeah. So I got a question here from Lisa saying, how do you keep the mortgage when you sell the property? I'm going to do a Facebook video totally separate to that and try and explain it. It's kind of complicated with securities and assets, and I'll pull out the big piece of white paper and do a video, chuck it up next week. So stay on our page. Dave might even share it on his. Depends if he agrees.
Yeah, good topic.
Do we feel that the 7% rate that they're using will lower at all? Do we think banks are going to ease off on that, Dave?
I think they're going to have to get some confidence about the medium long-term future before they'll do that. If you've got an outlook which thinks that property prices are going to come down, and if you start to look at banks assessing risk, and if they're going to lend to 80% and the property prices come back 10%, now all of a sudden they're lending to 90%. The only surety that you can get with that customer situation is their ability to keep making the payments.
Yeah,
so if they've got any wobble around what's going to happen to asset values, they're going to keep a conservative stance around their income testing because that will give them more surety over time. I think as we think about the market right now, I mean, we're incredibly busy. Clearance rates at auctions are up there. Prices are stable. Hopefully, if that keeps going for a period of time, that banks will get some confidence that things aren't going to be as bad as they are perhaps predicting.
Yeah, I think there's two trains of thought coming out of the banks as well. You've got the economists saying 10% drop, but then you've got the banks offering 2.6%. We'll see. Quick question here. Banks still doing cashbacks?
Yeah, they are, but in limited ways. So really kind of have reduced, some have reduced their cashback stance, but some have kept them up there. So probably cashback is a major point of difference on pricing between banks. Interest rate isn't. The rates just not a filter for us when choosing a provider. There are some cashback differences at the moment. Some have pulled back sort of 0.3, 0.4% of the loan amount. Some are still up there at say 0.7%, and that can make quite a difference on a big loan amount.
Yeah. Want to break from one bank and move to another and stuff. Shane, who we're streaming this through his Facebook page as well this morning, asks, it's the standard question, I suppose, that most people are going to ask is, are banks actually lending higher LVRs on properties at the moment? What are you seeing?
Yeah, a variety of stances have been taken up. If you go back to when LVR rules were in play, we had these exemptions, a new build exemption or a refinance exemption. Now those exemptions are out of the mix, certainly one of the things we've noticed is it's very, very difficult to get 95%. Yeah. Very difficult. Could get it on particularly new build, could get it particularly for first home buyers, but pretty much that's off the table, and 90% is it. It's still a standpoint right for first home buyers rather than refinances or top ups. So certainly, if you're an existing homeowner sitting at 70%, you want to leverage up to 90 in order to purchase an investment property. Yet that ain't going to happen. And the 20% on residential investment properties, in terms of policy or formal kind of notification, we're open for business here. There's only two places, Kiwibank and Resimac, that will do this. Our understanding with Kiwibank is that they want the owner-occupied home as well, which we're not a fan of. We prefer to keep these things separate. Resimac certainly are doing it, and as a near bank lender with a floating rate of 3.49, they're a very, very good option, and they will consider a slightly higher LVR over the home. So there's the potential there kind of now for an 85-80, 90-80 for them as a near bank provider. So that's useful. And today's big rumor is that the BNZ changed credit policy only this morning. And one of those changes is that they will open the door to 80% lending on residential investment property, with a couple of other changes, which is a huge turnaround, because a week ago, and if you're looking on my Facebook page, I was not a happy camper. They made some extremely big credit policy changes in a negative way. They tightened up. 1 week later, loosening up. So there's change happening so many every day, and it's exciting. It's actually a really exciting time to do what we do, because we're just adding
something totally different to talk about. And what I was saying, particularly with the BNZ thing that you were saying, is there's a rumor out there. Tomorrow it might be fact. The next day they might be cancelled again. But also, and I was explaining this to a gentleman on the phone, half an hour before we jumped on here, is if BNZ gets 100 applications every day, they first look at the people that are already clients of theirs. So premium stuff to the people that are already their client first. They'll then look at people who are bulletproof, and then everybody else gets shuffled down the line. And so if you've got rubbish income, a few defaults, you're not very strong lender, your paperwork's rubbish, you don't have enough equity, and you're changing from one bank to another because you can't afford to pay the other bank, you literally got no hope in hell. And so really you need to look at the strength of your application and get yourself up. Look at Credit Simple, look at your credit rating, look at your income stream, look at, absolutely everything you need to make yourself a stronger lender as humanly possible.
Yeah, definitely. Banks are, making sure that they're shoring their books up, and they're only making sure they're looking to quality deals. And I think, I've got a belief, anytime that things get really tough, there's a flight to quality. So banks are looking for quality applications. If you're an investor, you're looking to make a quality purchase. You start to look for the good stuff. because you can have more comfort and confidence in that.
Yeah, because you don't want to have the income stream of an airline pilot at the moment. You'd rather be pushing a trolley at countdown, right?
Yeah.
And I only half joke because it's kind of real. That's where the world is today. But like as we keep saying, it's changing every 10 minutes. Good question from Rachel actually. How long does a decent pre-approval last these days? If a bank gives you a pre-approval, is it good for like 3-6 months? What are we talking?
I mean, average it out at 60 days. You can get it up to 90. If in the higher LVR space, it can be 30. But average it out at 60 days and you're all good. The thing is also that with existing pre-approvals that we had in system prior to lockdown, instead of it just being automatically rolled over, what's happening now is we're having to go back in and freshen up income information and provide a lot more than we would have done to roll an application over.
All right. I had a question on Facebook this week from Philip, who asked also, what's the credit criteria looking like at the moment for developers? And for the sort of scale we're talking about, if I wanted to put 2 sections together, build 6 townhouses somewhere, how are banks looking at that as a lend at the moment?
Before we even went into lockdown, it was pretty tight. 1 or 2 had really shut the door on development stuff. And quite often, depending on what the purpose of the development is, it may well be a non-bank deal. Difference between developing to sell and developing to hold. So quite often there's quite a high demand around pre-sales, which becomes impossible for the client to implement. So we go down a non-bank path. Quite often we'll get in and settle with a bank because we're holding it. By the time you get all your plans and consents and everything sorted, we turn it off to a non-bank lender with a view, if you're going to hold it, to put it back to bank later. The good thing about that sort of endeavor is it's not the single domain of the banks. There are other suppliers who are in the mixer, and they can do things quite reasonably. But in that near bank space, certain non-bank space, they've kind of come down off the ceiling of where they were with LVR. So expect a lower LVR position, and again, it's got to be a strong deal.
Yep. Yeah. Leading on from that question, Ricky asks, what about new builds as investments and stuff? How are they looked at by the banks at this stage?
Well, banks will only look at it from the basis of will we approve this or not approve it. They'll never judge, and neither will I, on the quality of it as an investment. That's always going to be the client decision or the advice from the likes of yourself, Steve. I think for me, working with investors as I have for 13, 14 years now, the key with any purchase is it's got to give you what you don't have.
Yep.
And what I mean by that is that every single person who tunes into this will have a ceiling that's either based on their available equity or their usable income.
Yep.
And you never hit them both at the same time. You either run out of one or the other first. So if you're short on equity, it's absolutely critical that whatever it is you buy has the ability for you to add value to it and increase the value of it. So you can recycle your deposit out. Because if you don't, then potentially that's it. You're done. That purchase is all you're going to buy until there's a lift in the market. And if you've got great income, you've got all of this surplus serviceability that you can't borrow with because you've got nothing to hook into. You've got no security left.
Yeah.
And vice versa. If you're short on income and really, really good on equity, then you've got to buy yield. You've got to buy properties that yield their pants off to try and keep your servicing afloat for as long as possible. So your buying decisions respected to lending and your ability to lend is really encourage people to buy to their weakness. And in order to understand what that looks like, you've got to get your position assessed so you can get some guidance on that.
Yeah, and we're singing from the same hymn book that we have done for years, which essentially comes down to balance your portfolio. Give it something that's starved of and just keep it rolling along from there. Otherwise, you get these investors, and we see them, we'd probably both see them every day, where they've bought an amazing deal, but it's stopped me from buying anything else for the next 2 years while they get some equity going back or cash flow recovers. And the other thing I found with new build stuff too, particularly recently, is there's a lot of competition with the new build market now because new builds used to be the only thing that you could buy and only put in a 5 or a 10% deposit. And now with these LVR restriction releases, everything you buy can be lower deposit.
Yeah, I mean, and look, the new build exemption rule, meant that, with some clients, we were getting it on new builds as an investment property on a 10% deposit.
Yeah, absolutely.
You can't do that now. So, now that those exemptions have gone, the banks have chosen not to keep those exemptions in place themselves. They're making their own credit decisions. So that a new build goes from, yes, you can have a 10% deposit to, in most cases, no, you actually now have to have a 30% deposit.
Yeah. Particularly if that new build that you're purchasing is investment product for you and not your owner-occupier property. Yeah. And like we say, it's changing every 10 minutes. If you don't like the lending environment this week, just wait 5 minutes. Unbelievable.
It's a pendulum, mate. It'll go. We think pre-GFC, the pendulum was, incredibly loose. Then it goes to a tightening, and then it'll settle somewhere in the middle, sometime this year.
And I'll throw something wild at you too that I think is really interesting, and I've been pitching this at the moment to people as well. We've had bird flu, we've had SARS, we've had the GFC, we've had an Asian economic crisis, we've had World Trade Center, and now we've had a global pandemic, and nothing has knocked the Auckland property prices down 10%. The way that the banks and the economists are saying that it's going to. None of those have done it. Zero. And they're saying a 10% drop, and we're seeing prices at the moment go the other way. People are panic buying because they've been locked in their home and sitting looking at the same walls going, I really should get a bigger house, or really should buy a place. I don't want to live with mum and dad anymore. And I struggle with it. I really do. I'm sitting there going, I personally still think, and I said this last week as well on a similar talk, I think that Auckland property prices are a bit light at the moment. I think Auckland's due for another lift. It doesn't bomb. People go, prices went down. When? Show me a graph where prices went down. They go from boom to boom, and they just lose a wee bit of enthusiasm in between. They go flat for a while. And they've been flat for 18 months. They were warming up pre-COVID.
Yeah, pre-COVID, it was pretty hot. And I think, we can only comment on what we're experiencing. And, we're busier now than we were in March, and we were really busy in March. And I think coming out of lockdown, folks just are making effort to get to some sort of normality. So, if their plan was to buy a first home, they've come back to that plan. As long as their income hasn't been affected and they've got some confidence in their job, they're getting back to normal, and those can do. And I think that's the same for investors now who are going, okay, now this is a good time for me to get ready, and they are. Our investor activities is huge, and there's plenty of heat in the market, plenty of, as I said earlier, auctions are clearing out at a rate of knots. And you go online now and look at, how properties are being marketed, greatest percentage of them seem to be auctions.
In Auckland?
Yes.
It's not the whole country, Dave.
No, it's not.
Give you some stick. Hey, Aaron asked one good question about second-tier lending. Where's it sitting? How are they reacting to this market? What's your average sort of Resimac type lender doing?
Yeah, I think, by definition, I think there's 3 tiers of lenders. There's your banks, and then what I call near banks, which will be Resimac, Liberty, Bluestone, Pepper, all right, who have a genuine prime product where you have to prove servicing. It's a 30-year mortgage, and then you've got your non-bank lenders, right? So second tier, we're finding Resimac have come out really strong with some flexibility around policy, flexibility attitudinally. Quite often with this sort of thing, we don't get to get a feel for where appetite is until we've got a deal in. And that's one of the beauties of being a reasonably big-sized firm is we've got lots of activity going on. So we've got lots of stories, scenarios that are testing the waters all the time, and we're finding them pretty positive to deal with. They're wanting to, approve stuff. Pepper are the same. They're a really good partner of ours and have come up with some really good stuff. And then underneath that genuine non-bank lender has probably tightened up a little bit. Lenders that would ordinarily do 70 are sitting at 60. And that's because they don't overly test the servicing side of it. They're really relying on the asset value to protect their position. They don't have the income piece. It's normally a shorter term deal. Property trader, I'm going to buy this property, I'm going to renovate it, I'm going to sell it. There's not overly a measure of affordability in that mix. So they've just gone a little bit conservative on it, but they're still lending, that's for sure.
And are these non and second bank lenders, are they government backed? Are they secure? Are they tight? Are they strong? Or are they a little bit, Lombard, St. Lawrence? I mean, what are we looking at here?
Well, the main sort of providers all operate out of bank warehouse funding lines.
Yeah.
And yeah, so and that's where, like, Resimac is an example that operates out of a Westpac warehouse funding line. So the LVR restrictions are removed from those funding lines as well.
Yeah.
So that gives them some flexibility. And a few of the non-bank lenders, again, Westpac, BNZ tend to be the dominant providers there. Then you've got an outfit like First Mortgage Trust who lend investor funds, and they're the country's biggest non-bank lender. And they tightened up very quickly. Now have started to loosen off a little bit. And what they're, of course, finding is that investors are giving them more money because bank term deposit rates are so low. So they're going to get liquid. And in order for them to make margin on that money that they take from investors and give them a return, they've got to lend. So
very interesting point, because this is going to get really good if we have Reserve Bank interest rate reduction. We're at 0.25. If they go zero or negative interest rate, you have to pay the banks to hold your money. And so suddenly banks are going to be like, out the door you go. Mortgages for everybody, it's going to have to go that way, particularly with quantitative easing. The guys you online who don't know what quantitative easing is, it's literally the bank getting the stamp out, the government getting the stamp out and making more money and flushing it through the economy. I've got this particular theory, and I know we're getting up to 40 minutes now, but I'm going to throw it out there just quickly before we end this. My theory is that we have stupidly low interest rates. We have no reserve bank issues anymore. We have banks that want to lend money. We've got houses that are in an upward market. We're not in a recession yet at all. We haven't had 2 periods of downward growth. We've got good quality housing stock, and we've got jobs mostly. Put the big disclaimer in there. I think this is the Indian summer. I think this is the golden time. I think now is the time for people that have got a couple of properties and want to invest some more to go out there and actually cement their portfolios and make themselves incredibly wealthy for the rest of their lifetimes from this. I think that
it is. And I think the key for me is that there are two things in my mind that fuel rapidly rising asset values, and that's cheap credit and easy accessibility to that cheap credit. Now, we've got the cheap money, but we don't have easy access. Now, if the banks loosen up on their credit policies in forthcoming months, that's a sweet spot where asset values could take a real lift. My thought would be get in before that happens. So if you're in a good position right now and it's the right time for you and you're confident around your income piece, your business has got through this and you're looking good, then I'd certainly get yourself at the starting gate. Because in a few months' time, if credit eases up, then more borrowers are going to access more money. And now it could go the other way. None of us have got the crystal ball on this, mate. And we got to stay mindful that mortgage deferrals run out in 3 months, wage subsidies run out. There's going to be more hurt to come. We know that. There's going to be two distinct groups: the haves and the have-nots. That's life. It always has been the case. And if you're in a good position here and you're smart about what you do, it is a good opportunity.
Yeah, but for every negative you've got like that, you've also got the numbers of listings on the market at the moment. Auckland's historically low. Wellington and Christchurch are incredibly low. Paraparumu, Kapiti Coast, Rotorua, Tauranga are all at historic low levels. People got a lot of greed, and I don't say that in a bad way. I say it in a Gordon Gekko sort of way. Greed absolutely is good, because people, if they think the market's going to go up, they won't list their properties and sell them. They'll hold on to them. It's a ticket to play. And the next biggest thing after greed is FOMO, fear of missing out. People who don't own property want to buy some. There's only a housing crisis if you don't own any. And everybody doesn't own a house. Just going to rant on my page now about that one. But there you go. So I'm going to close this up now. We're at 44 minutes. We've had 60-odd people online, some great comments. If you have any more questions or comments, chuck them on the page there. I've thrown Dave Windler's email address up there if you have any more questions or want to work with Dave.
Yeah, fire away.
Fire in. Also, you've got my webpage, stephengoody.com. Massive amount of blogs on there now. I've chucked all of my media pieces up on there. I've put a whole pile of stuff on there. And both Dave and I are also fairly busy putting stuff up on Facebook as well. So hit our page, like it. If this video has been useful to you, share it on my page, from my page to your page, share it from Dave's page to your page. Sharing's caring, and chucking a like on and putting a comment on puts it out over onto your network as well. We really, really appreciate that. So if you've enjoyed the free information that Dave and I have spent an hour bringing to you, then share it and show some love there. And lastly, I'll just say 45 minutes just disappeared. This stuff's real interesting. 60 people online stayed for the entire video. We're going to have to keep doing this because this stuff's great. And I think it really helps the market understand what's going on. But a big part of it is you guys provide your questions to us so that we've got something to talk about and answer questions for you. So thank you guys for that. And thank you, Dave, for joining us. It's been really useful as usual, and great content. And have a great weekend, everybody. And we'll see you after the long weekend.
Cheers,
thanks very much.
Thank you all.